welcome to everyone who is or who has joined this morning and those who are watching the recording. What I'd like to do before we kick off is if you open the chat box, what I want you to do is type in where you are dialing in from today. So if you just pop in the town, cool, there you go. Look at everyone pop up on the screen. Quite a few from Brisbane, Central Coast, New South Wales. Very cool. Yeah, good. Well, anyone from West Coast, WA, NT, there we go. Awesome. Well, it's cool to see that, we're dialing in from all over Australia. Now, you may notice a couple of things that are going to be a little bit different about this webinar. I've been presenting a little bit differently over the last few weeks, and it's just, I find it's a lot more interactive, the way I can control the screen and get audience participation. So there'll be a couple of moments where I might ask questions, and the chat box is where the magic happens there. So the other couple of things I might get you to do is keep in mind that you can react, and the reactions will pop up on the screen. And then the other one is if you pop your webcams on, that'd be handy. Just to almost create a bit of a workshop environment versus, just a webinar where you're there to digest. The other thing that helps, attention, concentration, but also will max out the experience from the webinar is if you full screen Zoom, and then you'll be able to do things like see my slide deck a lot better that way. So, cool. Alrighty. Well, so I've mentioned cameras on, Zoom full screen, and then have the chat box handy as well. And just a quick intro before we get into the content. My name is Ben Walker, and I run an accounting firm based in Brisbane, but working with small business owners all around Australia. We're quite well known for our focus on our ability to save tax. The count of our tax savings for our clients is up to $29 million at the moment. And we're just about to start a campaign through tax planning time that we're expecting that to hit about $35 million. So about another $6 million for our client base in tax savings through this next tax planning season. So our team are getting pretty excited about that. As I said, my name is Ben Walker. I kicked off Inspire when I was 23 years old. I've got 17 years accounting experience, and I'm the author of Wealth for Life and It's All Sorted. So that's 2 books I've written. It's All Sorted. I'll sort of showcase this, came out towards the end of last calendar year. And the whole premise of that is the 9-step guide I've put together on helping business owners master their tax and achieve peace of mind. If you do want a copy, feel free to grab it. Using the QR code if you'd like. And thank you, Tay, for popping the link in the chat box there too. All righty. Now, we might change gears into the topic for today, which is all about buying your commercial property. And we'll sort of cover quite a few different lenses. It doesn't really matter what sort of entity you buy it in, but we will talk about how it looks in superannuation or outside of superannuation as well. And the sort of topics, so I guess I've touched on a few there. We're structures we use, lending options. Now, I might just say up front, I'm not a mortgage broker. I used to be. I did that for a little bit. Banks drove me mad, though, so we've handed it over. So my experience here is observations, not advice, from what we've seen our clients do in the lending space and what we're seeing out there at the moment. The SMSF ins and outs. So we'll cover, what sort of things you can do with property in super or SMSFs. And then the last one there is case studies. So I think we've got about 5 case studies of clients over the last few years of, what they've done with superannuation when it comes to buying commercial property in particular. And now, in terms of SMSFs on its own, I've had a bit of a love for SMSFs since I began my career, actually. So I've been an SMSF member since 2011. Wow, that's a few years ago now. I've looked after hundreds of SMSFs over my career, including when I started. So I was like 18 years old at KPMG, and I ended up auditing a heap of SMSFs. It's boring as it doesn't sound fun, and it isn't. But I learned a whole heap of the rules. About 60% of Inspire's SMSF clients hold some sort of property. So most are commercial, but there are resis. There's quite a few people who do property development through their superannuation as well. And I've been an advisor on many purchases and restructures. The case studies are sort of the tip of the iceberg when it comes to the stuff we've done, but they're just sort of examples to bring a bit more real world picture to what I'm talking about on the theory side. And about 28% of our clients who are all small business owners have an SMSF as well. So it's just under a third. What's the point of sort of talking about this topic now? Not every business, but there's quite a few businesses where their business relies on a physical premise, particularly around the continuity. So, whether the landlord risk is a real thing. Some of our manufacturing clients, if they were to have to move at the end of a lease, it would cost them hundreds of thousands of dollars. So that's one of the things is they want to secure long-term stability there. Other businesses don't need a physical presence, and I think what's happened there is COVID's dropped a few tenants off the map, and you see things like co-working spaces pop up. What that means is that there is a balance of property there that's maybe an opportunity if it's going to be helpful to business growth. Opportunity for those who need or want their own commercial property to purchase. Now, the other thing is I'm talking about the context of buying a commercial property for your own business, but this could be just a way of buying commercial property to invest into. But the lens I'm looking at is really as business owners, those sort of strategic moves. I'm happy to take questions, whether it's just purely to get a third party tenant in as well. All right. And the other thing is, as I said, the chat box is there to ask questions as we go. If there's a question that I'll answer later, or I've sort of already talked about that topic, I might get to it at the end. But let's just get stuck in. All righty. So the first thing we want to have a chat through is the different structures available. Now, this applies to buying a commercial property as it does to running a small business. And this is sort of the table we show clients when we're sort of looking to, when we're looking at investments or business structures. And the options are sole trader, company, trust, or SMSF. So broadly, that's the four options. There are details under certain ones. But we've got the tax rate is one of the first things we compare, where it's up to 47% in your own name. Now, this is a typo. It's an old slide, this one, but we're down to 25% if a company runs a small business, or 30% if it's investment only. We've got trust at 0%, where that's a bit of it's not legitimately a 0% tax rate there. But the trust allocates their profit in the year to beneficiaries, so individuals or entities within the family group, and then they pay the tax on the trust's behalf. And then the last one there is SMSF. Now, that is a 15% tax rate or a 0% if you're in pension mode and you've met certain conditions. Oh, thanks for updating that slide in the background. Very cool. Alrighty, so we've got SMSFs. Now, that is that pension mode is literally 0% tax, no Cayman Island stuff. It's all legal, but we do have to wait till a certain conditions, which is usually 60 years or more, and you've ceased gainful employment is the wording they use there, or you're just above 65 years old. There are a few other conditions of release though, but generally we've got to wait till our 60s to get on that 0% tax rate. Now, the other thing that's quite relevant for property is 50% CGT discount. So you get that if you own the property in your own name, but the problem with owning a commercial property in your own name and selling it, if you make a gain, then you might be stuck on this gigantic tax rate of, half of the gain just goes straight to the tax man. So often, we would never recommend buying a commercial property in someone's own name for tax reasons, but also asset protection. But we might keep on moving to the other options. Now, we've got the 50% CGT discount isn't available if you hold the property in a company, or if a trust makes a capital gain and distributes that gain to a company. They don't get that 12-month. If your assets held more than 12 months, that 50% CGT discount. Now, depending on the the income of our clients' family groups. Occasionally, we will actually recommend a property to be purchased in company, so it does happen, but it's not our sort of normal way we do things because of that CGT discount. There's other reasons as well why we might want to hold via a company. Just to be clear, what we're not talking about is the company that runs a business, because we don't want business assets in the same entity as the business risk associated with that property. Alrighty, so then if you own a commercial property through a trust, you do get that 50% discount. And then the last one here is SMSF. You do get a discount. It's just not 50% in an SMSF. It's 1/3 of the gain if you hold the asset for more than 12 months. So it turns out to be, instead of a 15% tax rate, you're looking at 10% on capital gains owned more than 12 months. And yeah, as I said, we primarily use trusts and SMSFs. Occasionally we'll go to companies depending on the client group. All right. So in terms of lending options, again, lending observations, we've got outside super. So this is relevant for commercial properties in own name. Again, probably not ideal. Company or trust. It's slightly less complex than SMSF lending because we don't have this thing called an LRBA to deal with, but we'll talk about that later. Higher tax outcome, and we can just see that by looking at the tax rates in super versus the alternate options. We can often use the business or personal income to service the debt on commercial property held outside of super. So that's one benefit if you're struggling to sort of meet the requirements of serviceability for the banks. In your SMSF, you might look at this option for that reason. But the other thing is, if your business is renting a current premises, we've heard of banks that will take, if you're paying 100 grand of rent already, they'll add that back and then take off whatever the market rate rent for your property is. So it sort of weighs into your serviceability that way too. And you can use other properties, equity in other properties or other security for the deposit, where SMSFs, you have to have the cash for the deposit. So that's some considerations for outside of super. What about inside of super? So the LRBA, I've got a graph that makes that. In fact, I'll just see if I can skip to it. So the LRBA is the thing we've got to deal with. And the whole reason why this limited recourse borrowing arrangement, or LRBA, exists is because SMSFs in their own right cannot borrow to buy property. So it's some sort of weird workaround, but you need this bare trust that exists and sits in the middle between the property itself and the SMSF. And the bare trust is the owner of the property until the loan is paid out. So the bare trust is the name on the title and on the contract. The bank lends money to this bare trust, but really all the income and deductions are picked up in the SMSF. It's one of these weird legal ways of actually getting the outcome that we want, which is borrowing money for property in SMSFs. You can borrow money for other things in SMSFs as well, but there's tons of rules and conditions around that. So property is the most common with LRBAs. Now, the lender can actually be a bank, or it can be from your own cash. So what we've had clients with significant amounts of money in their bucket companies, and they're essentially acting as their own bank. So they'll lend their bucket company cash through an LRBA into their SMSF. So many acronyms here, and then the SMSF will pay back their bucket company the repayments. So again, that's a fairly common one we're actually doing, where the client has a fair bit of cash and they want to. And actually, one of my case studies is that too. So I think that's case study number 1. So we'll come to that soon. So skipping back to this slide here. So we've talked about LRBAs. Now, in terms of serviceability, again, what we've seen with the banks is that they're looking at your super contributions, which could be yourself and your spouse if there's 2 of you in the fund, and then also the rental income from the property as well. So if the property is going to earn 100K of super contributions, and then yourself and your spouse are putting in 27.5 grand a year, then that's over 150K of income to the fund that the banks might look at for serviceability. Now, the other thing here is that, the tax is 15% or 0%, or as we know, the 10% on capital gains for gains over 12 months. There is a smaller amount of lenders who will do this stuff, but I still feel like it's fairly accessible to most people to get get banks to come to the party on this stuff. Typically a higher interest rate, but again, they're not seriously higher than outside of super options. The lender can also require advice, so legal advice and financial planning. Now, they can require this with non-super purchases as well, but we see it's more common. I haven't seen it for a while though, but they'll ask you to go and have a consult with a lawyer and a financial planner to get them to sign off. It's just the way of the bank passing on risk to third parties, so that if anything bad happens, that they can blame someone else. So, and again, like with SMSFs, it should be done with care, because you are essentially, investing with your retirement money. So it needs to be taken seriously, and that's maybe part of the element they're going for as well. But yeah, I think banks are about de-risking their own themselves. Now, so lending in super needs a cash deposit, and we cannot borrow for construction. So what we can't do is, buy let's say a block of land and then build a house on it, where the construction part is through lending. So there's SMSF rules that prevent that. But you can buy an off-the-plan property where there's a single contract through SMSF as well. Even if it's, you sign the contract now and it settles in 3 years' time, all of that stuff is able to be done pending certain requirements are met. Now, in terms of other things to consider, so if it's a commercial property for your own business, in an SMSF or outside of super, you can owner occupy, which means your business can rent from your SMSF or rent from your trust or company or whatever entity you buy your commercial property in. That's pretty straightforward. We always recommend a lease be put together, even if it's a simple lease, just outlining the details around, how much is paid, and it needs to be pretty much, in most instances, we need to make sure it's market rate, especially when it comes to SMSFs, that you're not paying heaps more rent than a third party would, or you're selling the SMSF short by paying under market. So you need substantiation for that, and it is something the auditors look for. And yeah, I've seen LVRs go to 80% on both inside or outside super. Even higher outside of super in certain circumstances. Geez, there's still a few people joining. There you go. Welcome to those who've joined since the start. So just a heads up on that, there will be a recording that goes out to anyone who's registered. So if you have missed the first bit, that is all good. Alrighty. So in terms of deposit required, again, massively depends on the lender here. But postcode, asset type, the price, and if it's your own business, they might look at your financials in your business as well. But what we often see is that 20 to 30%, this is in SMSFs, 20 to 30% deposit required plus stamp. And then also some of the lenders need about 10% of the value of the property in cash after the transaction goes through for, things like paying the bills and anything that comes off the back of that. So they sometimes have a liquidity requirement as well. Again, it's not on every single transaction I've seen, but it can be a potential requirement. Now, in terms of the buying process, what I would suggest you do is work out what's the strategic reason why you're looking to buy a commercial property. And this is even before pre-approval. Like, is it for long-term security for your business or expansion, whatever it is, make sure it makes sense from a value perspective, strategic perspective, and then you can get pre-approval. Now, if you're looking to get finance in an SMSF, you can actually get pre-approval without having to set up the SMSF, which is actually great, because lenders will actually look at your current superannuation accounts, even if they're with non-SMSF superannuation providers. and they'll take, they'll have a look at what your contributions have been over the years, plus other factors to assess serviceability. So you can get pre-approval before you go and spend the money to get it all set up. Because let's say you can't afford the property you're looking for, but you've got the guidelines of, hey, I need this much more in super, then you can come back in a year or two if an SMSF isn't suitable for you at that time without having to have gone and set it all up. So that's pretty cool. And similarly, outside of super, ordinarily we can achieve the same thing, which is pre-approval without having to have the trust or the company that will end up holding the property set up. That can come later, or at least after pre-approval. Alrighty. So once you've got the property, then in terms of signing a contract, you actually need the entity names that will end up owning that property. Now, for an SMSF, remember I mentioned that the Bear Trust will be the owner, or the trustee as trustee for the Bear Trust. There's a tongue twister there, but you need that set up, which means you need the SMSF set up to actually sign the contract. Now, in terms of the lead time on SMSFs, it's hit and miss. Unfortunately, we can have SMSFs set up and then the client gets their existing funds rolled over within weeks. We've seen them be really quick, but we've also seen them blow out, which hasn't been good. Or the ATO can, on the odd occasion, basically interview the trustees or the people setting up the SMSFs just to assess if they think they're suitable for an SMSF. I've seen that happen once with an SMSF setup. So it doesn't happen every time, but it can hold up the process, prevent the ABN getting issued until the ATO is happy that the client knows what they're getting themselves into. So yeah, that's why I say 1 to 2 months to be safe. But again, I've seen it take those full 8 weeks to get them at least the money coming in. So we don't want to make that process stressful, especially if you've got a signed contract on a property that's conditional on the finance or all sorts of things. We don't want to be super under pressure there. So the more notice you can give accountants or whoever's helping you with that SMSF, the better. Now, in terms of the alternative, so non-SMSF purchase, again, you'll need the trust or the company name to sign the contract, whatever is going to end up owning that property. And then the other thing is the lead time on a company or trust is way shorter because there's no rollovers that might need to happen or third parties in most cases to rely on. I've never seen an ABN held up because the ATO questions whether the client is capable of it for a company or a trust. So cool. Next step is well, obviously, if you've got the property, you find the property and make the offer subject to whatever conditions that you need to. Typically, we see finance, and then due diligence, DD, is also another common one. But again, you want to have a chat to the lawyer that's helping you with the conveyancing, looking through the contracts, helping you with all the searches on that property to make sure that what you think you're buying is actually what it is, and there's no dramas. And again, we've seen people unfortunately go through the process of setting up SMSFs, getting through to finance and DD stage, and then pulling out for whatever reason. Like it does happen. It's unfortunate, but again, in that was actually recently. That particular client's still looking for a property, but yeah, it can happen that you don't end up going ahead for whatever reason. But yeah. Alrighty. And then obviously once we've got the signed contract, we want to go from that pre-approval stage right to getting unconditional finance and then through to settlement of that property, and you get the keys. So that it's in sort of high level, broad steps, what the process looks like. Now, in terms of the other things before we get to the case study, so we've talked about LRBAs a fair bit already. So there's other options. You don't necessarily need to borrow in SMSFs to buy commercial property in it. The one of the ways, which is super easy, is if you've got enough cash to pay cash for it, then you can do that. Buying it outright, you can also, there's a certain trust structure where you can use some of your inside of super cash and some outside of super cash to purchase a property where there's no actual lending on the property itself. So yeah, not a super common one, but it is possible even if you've got access to debt outside of super, and you've got a bit of a cash balance in super, you can do part and part with an entity that you have outside of super, and cash in super as well. And then there's also another type of trust we can use where there's more than 2 or more business partners, and that might even be one of our case studies coming up as well. And you can borrow against the asset in there without that LRBA drama in the right instances. So there's basically what I say to clients with commercial property or even property development is tell us what outcome you want, like paint that picture from a how you want it to operate, and then we can give you the options of how it could happen based on your circumstances. So we'd run through the 6 or 7 ways it might be able to happen, and work through what the best outcome for you is. Alrighty. I haven't seen any questions come through, but if you've got them, just pop them in the chat box and we can run through it. Case study number 1. So we're going to transition into case studies now. The first one there is the vet from the bush. So he held a property outside of super, valued at about 300 grand. It was for his vet clinic. He had a loan, which is sort of a weird style of loan that expires, I think, every 5 years. You've got to renew it. But he used that as an opportunity to move it into super. So he had about 150K-ish, and these are rounded numbers, in super. And he basically had enough in super to pay out the loan on the property outside of super, but we've also got to consider the getting it in there. He lent the remaining money, so he's got to buy this property for 300 grand in the name of his super fund. He pays 150,000 bucks from his SMSF to the current bank that was against his own name, and then he borrows the remaining 150 grand from a related entity of his. So this is the SMSF now borrowing the 150K difference from his other entity. And then what he's doing is he's actually paying, when he pays his 27.5 grand of super contributions a year into his SMSF now that it owns it, and he's also paying his rental, like his lease, the rent that's owed on that property into super. He can actually make those, the SMSF can actually repay the debt it owes back to his related entity up to the value of whatever that original loan was, which is 150K plus interest, because we do need to charge interest even if it's self-funded like that. So it's a really cool circle for cash flow purposes where you're getting a tax deduction for rent and your contributions, and you're literally pulling that money straight back out as a loan repayment to the entity that made that loan. So it's a pretty cool outcome. And just on that question, Aline, you've asked, business property can be transferred to an SMSF. Yes, yeah. So that's the short answer, is as long as it's even if it's a related party, so you own a commercial property outside of super in your own name, a trust or a company, we can transfer that in. Now, whether we pay cash for it or use up your contribution caps, there's a few different ways we can do that. Or vet from the bush, he lent money, so he paid cash for a portion and borrowed money from himself to make the difference up. So there is a few ways that can happen, but it absolutely can. Now, just to add, I'll pop that question back up. Aline, my answer is in particular around business property. You cannot do the same thing with a residential property investment, where you might own an investment property and you want to flick that into super. It can't work the same way. There's a general prohibition on transfers of assets into super unless they are commercial property. So that's one exemption. And then the other one is listed shares or units in listed unit trusts. So where there's a daily market price for them. So there are your two exemptions. So resi property or heaps of other assets are not doable there. Is there a limit on property value? There's no sort of stated limit, but you're limited to your ability to get it in there through contributions or debt. Now, you've got contribution caps to consider, and then the other thing is which can be non-concessional or non-tax deductible, or tax deductible contributions to use up. And then the other thing is if you want to borrow from yourself, like the vet from the bush, it's got to be within arm's length terms. So you need to, so you've got another limit there where, a bank won't lend you 100% of your property value under a LRBA in super. They won't do it. So you couldn't just have 100% loan on it. You've got to apply, and what I tell clients to do is go and get a couple of different offers or scenarios from banks. This is if they're self-funded, and we'll use the same terms or the average of 2 or 3 different banks' offers to come up with their own self-funded agreement. So there's your other thing to consider as well. Alrighty, now case study 2. So we had a client who purchased, they had a commercial property in their super fund for quite a while. It was worth $1 million. It was in a trust outside of super. So this is going back almost a decade now. Owned outside of super. It got transferred into super at about $1 million. The client shifted into retirement and wanted to move money and assets into super. And they used an LRBA with a bank to buy, I think they had about 300 grand in super, borrowed the rest from a bank. It wasn't owner occupied, but that doesn't really matter. This case study could have happened if it was owner occ. And then they received rent because they're in that retirement phase, meeting those certain conditions at a 0% tax rate. 2 to 3 years later, after transitioning that or transferring that property into super, they got an offer to buy that property for 300 grand more than it was worth 2 to 3 years beforehand. Because that client was retired, they ended up paying no capital gain on that 300 grand profit compared to what would have been 30% tax or more outside of super on the net gain. So that's a strategy where they initially had 300K or so in their SMSF, and within a few years they'd more than doubled that through contributions and rent received and the increase in market value there. Alrighty, another case study is an IT business in Melbourne. So the business was previously renting and it grew rapidly through COVID. The owner had an opportunity to buy a property near his home, one of those sort of small warehousey units with a mezzanine top. The property needed a fit out, which was funded through, so he was a bit short on cash in his SMSF. And so while he was able to complete the purchase, it was the fit out that needed to happen, put a couple of walls up, bits and pieces like that. And basically his business prepaid a year of rent to the SMSF to go and cash it up a little bit to carry that out. Fittings and furniture were paid by the business itself to access the instant asset write-off. And the client is now paying similar rent than he was previously, but he owns the asset and he's paying it into his SMSF. That's that same rent. And then, since that transaction happened, I'm sure the price of that property has increased a fair bit. Case study number 4, a service business client who's in the building industry, again, grown through COVID. He had an existing home office hitting its limit and had a baby on the way. So he didn't want, first baby, didn't want the team coming to the house every day after that point. The client purchased a property at 800 grand, also quite close to their home. This one's in the SMSF as well. It was about 75% loan to value ratio. So we're looking at ballpark 200 grand deposit plus stamp duty in super. But he had a bit more than that in super. Needed renos, liquor paint, etc. And again, funded in super from cash. And then the furniture paid for by the business for instant asset write-off. And the client now has a lovely shop front to take him into the next stage of business growth. So again, similar to the last case study. And then this last one is a different structure. So it's not just purely, let's say, an SMSF purchase, but we've got 4 business partners buying a property. Again, this was a situation where we gave them a few different options to make it happen. They all had SMSFs and they all had at least 200 grand or so cash to put down a deposit. To basically pay cash for the property, where you got 200K times 8 SMSFs. The purchase price was about 750K. So they had a bit of change for stamp duty, etc. And the structure we used was an ungeared unit trust. So there's no borrowing to a third party or a bank on this property because of the type of trust we purchased this in. And each business partner owns 25% through units in a unit trust, which again, it's owned outright through this entity. Now, the way this trust is structured is we cannot go and use the equity in it because it owns 100% of it to then go and fund another property purchase. That's the sort of one of the downsides with an ungeared unit trust. But again, depending on the circumstances, there may be other ways to still achieve this sort of structure where you've got multiple business partners, but still borrow money against it. There's that suit option, which we talked about earlier. So cool. That is basically the end of my case studies. Now, the last thing here is if you do want to talk further about this, then feel free to book a strategy call with one of our accountants. My 18-month-old lovely daughter's just popped in the office, so let me go and pop her back outside. You want to say hello? Sorry, just give me a sec. All right. Yeah. So feel free to, if you do want to talk more about this with one of our accounting team, book in for a strategy call. Now, we have, at the start of this year, we switched to referral only as an accounting firm, which means to book a strategy call, you have to put in whoever's referred you in there. I can see some clients on the call today, but there's also some regular webinar attendees or friends. So if you've known me for a while, feel free to use my name. But yeah, it is a requirement to pop in, and Google doesn't count. Yeah, if you do want to talk more about that, then feel free to book that strategy call in. If you're an existing client, then please reach out to the main contact person that you work with at Inspire to run through what it might look like to buy a commercial property in your family group. And then, yeah, I guess from here, I'm just opening it up to Q&A to answer any questions that popped up. Alrighty, first one here. Nick Ellis, you mentioned that the SMSF paid for renos. Would it be reasonable for the company to pay for these rather than the SMSF? You can, either way. So we've got if the landlord is the SMSF, the landlord could do renovations or touch-ups on the property. We just can't use borrowed money for that. But then as a tenant, as long as the lease agreement allows you to, you can also do whatever you want with renos. So it comes down to what's the better tax outcome. Now, if it's structural renos and you're looking at from the business perspective, often we actually have to write those renovations off over 40 years, which means if you go and dump 40 grand into renos, it's $1,000 deduction a year. So it's really low. In an SMSF, same outcome. You need to write it off over 40 years, but it's not sort of coming out of your pocket at bugger all deduction outside of super, if that makes sense. So I'll say that another way. You spend 40 grand outside of super to get $1,000 a year deduction versus, and one of my case studies was prepaid rent. Prepay 40 grand of rent, get a deduction for $40,000 when you do that. It goes into super, and then the SMSF gets $1,000 a year deduction. Nick's also mentioned, so maybe no for structural, but not for structural. Yeah. So again, we look at the type of depreciation that So structural generally we need to write off over 40 years, and then things like desks, chairs, laptops, that sort of thing we can write off. And current rules, it's up to 20 grand we can write off as a tax deduction. Alrighty, small business buying a commercial property to use/run the business. Other finance fees, mortgage fees, fully deductible. So the interest is a tax deduction, if that makes sense, Aline. So yeah, and then the actual setup fees and that sort of thing. I'm pretty sure it's over a few years, but I mean, if that's important, then feel free to reach out and we can give you some personalised guidance on that. Cool. Scott, SMSF double transfer duty. So stamp duty is state-based, and Scott, you're an accountant. You can look this one up based on the state for the situation you're looking into. So yeah, feel free to suss that out. But yeah, stamp duty needs to be considered on a purchase from an SMSF or a transfer, yeah, it's very much state-based. So that would be depending on where you're calling in from and where your property is really. Would it be a business loan by the SMSF? So the interest rate is higher. So I wouldn't call it a business loan necessarily. It's its own lending rules, which is limited recourse borrowing arrangement. So the LRBA, typically the rate is higher, but it's not gouging levels like an overdraft versus a secured business loan. So yeah, have a look at the differences. And yeah, usually a mortgage broker who can help with who's experienced with LRBAs can usually get a couple of different options from the few lenders that will lend to SMSFs. And they can come back with, all right, if your property's worth $1 million, you've got 300 grand in super, here's your rate, term, etc. And we've even seen 30-year loans lately that the banks are offering. Usually they were only 15 years or even 10-year, but they had to be renewed every so often. It's the space is constantly changing with SMSF lending. So yeah, the place to go and get the I guess your interest rates and terms and all that sort of thing is, and even repayments, because that's relevant when you're looking at funding this, is your mortgage broker. Cool. Thanks, Scott. Aline. Cool. I think that's all the questions that have popped through so far. So yeah, if there's nothing else anyone had the question on, then I hope that's been fairly helpful for you. Cool to see quite a few clients on the call as well. So again, if you are already working with us, then feel free to reach out to the accountant that you work with, and yeah, we'll be able to guide you on what way to acquire your commercial property. All right. Thanks everyone for joining. Thanks, Nick, Helene. All righty.